Hello, everyone, and welcome to Unraveling the Mystery of 1031 Exchanges. This is our webinar that's designed to literally unravel the mystery. We get people who call us and say, I've spoken to 3 or 4 people, I get 3 or 4 different answers, and I'm really confused as to what really matters, what really counts, what really needs or required to be in compliance with the 1031 exchange transaction. So our goal today is not only to talk about the requirements, the basic requirements, and we even get into some intermediate and advanced level topics, but to really point out the areas where there is confusion out there and why there's confusion, what really matters, etc. So having said that, a few housekeeping things while we wait for a few others to join us. We have a lot of folks on the webinar today, so we're going to keep everyone in a listen-only mode. That way it eliminates all the background noise. We're going to do things a little bit differently this time around. In the past, we've taken questions as we go. And what we found is we get a lot of questions, so we always go way over the 1 hour we had scheduled for that. So this is really a 45-minute presentation approximately. And then after that, we're going to open it up for questions. Now, as you go along, feel free to post the questions in the question box on your console. We're going to track all of those. I can see them right here on the screen as they come up. I will try to cover them during the presentation. After we're finished with the presentation, then we will go ahead and start addressing each question one by one. And this time, after the 1 hour, we've allocated an additional hour afterwards. So for those who would like to hang out with us and just keep asking questions, you're welcome to do that. But the actual presentation is about 45 minutes. After that, we'll have plenty of time for questions and answers, and we can drill down as deep as you want. We can go as basic or advanced as you want. Anything like that is perfectly okay. So having said that, my name is Bill Exeter. For those who haven't worked with us or me before, I'm the Chief Executive Officer for the Exeter Group of Companies, and that includes Exeter 1031 Exchange Services and Exeter Trust Company. That's my QR code on the first screen there. So if you want, you can take a snapshot of that, and it will bring up my contact information, copies of our guidebook, etc. But also in the handouts, there's 3 handouts in the presentation itself where you can download some of the information we have, especially our guidebook, which you can see there on the picture. The guidebook's about 30 pages and really walks you through all the basics. We're going to cover all of that today, but that'll be something you can kind of keep for future reference, etc. And of course, we're always available to answer any questions you might have, so feel free to reach out to the business development person who invited you to attend, and they can always get us in touch and chat about questions or challenges you might have. We try to be more advisory, more consultative in nature to help walk through the process, what really matters, and then solve any problems that might be coming up. So having said that, haven't seen any issues, so I think everybody can hear me okay. If you can't hear me okay, post it in the question box on the console to make sure that I know that. So quick introduction to who is Exeter 1031 Exchange Services. We are a full service qualified intermediary. People also call us an accommodator or a facilitator. That means we're kind of the quarterback. We actually administer the 1031 exchange transaction. We also serve as the exchange accommodation title holder when there's, legal title has to be acquired and held by us for reverse 1031 exchanges or improvement 1031 exchanges or something along that line. So we do both. We're the qualified intermediary and we're the exchange accommodation title holder. So whether it's any type of 1031 exchange or any property that's located anywhere, we can take care of it for you. So just kind of reiterate that we administer all types of 1031 exchanges. That includes forward 1031 exchanges. Forward 1031 exchanges is what we're going to focus on most. That's where you sell your relinquished property first, and then you purchase your replacement property second. That's about 96% of our transaction volume. So by far in the industry, that is the most common 1031 exchange structure. It's the most simplified, the fees are less, etc. It's a lot more straightforward. Then you have the reverse 1031 exchange, and the reverse 1031 exchange allows you to actually purchase your replacement property first. So you can go out, negotiate, acquire, and close on the acquisition of your new replacement property before you close on the sale of your relinquished property. Now that sounds great. It actually solves a lot of problems, especially in today's challenging real estate market where you've got really tight inventories and you're getting multiple offers and bidding wars and you've got high interest rates, etc. But the reverse 1031 exchanges are also a lot more complicated. There's more costs involved. So we'll talk about that a little bit, but it allows you to go out, find the new property first, negotiate, go on a contract, open escrow, and close. Actually close on the acquisition of your replacement property. The challenge with the reverse 1031 exchange is you can't take title to the property. The IRS doesn't allow that. So we actually set up an LLC just for your transaction. That LLC is used to acquire and hold or park legal title to the new property. And then you've got your 45 days to identify what you're going to sell and 180 days in which you have to close on the sale. So it does solve a lot of problems. You know you've got your new property locked up, but it is more complicated, especially with that parking arrangement where we have to take title to it. Lenders aren't terribly excited about that. You also have improvement 1031 exchanges, and improvement 1031 exchanges are where you are selling your current property. You use some of the proceeds to acquire and hold or park legal title to the new property. So it's the same kind of scenario as a reverse 1031 exchange where we're holding title to that new property. And then you're using the rest of your exchange funds, your net proceeds, to make improvements, retrofit, or construct something on the property that you've acquired through us. And you've got the 180-day window to make those improvements. So the challenge with the improvement 1031 exchanges, of course, is, again, it's a lot more complicated. You've got that parking arrangement where we have to hold title to that new replacement property. Lenders don't like that. So if there's any kind of financing involved, that can be a challenge. And then getting permits and going through that process and then actually constructing whatever the improvements are during that 6-month period can be very difficult. So you don't see a whole lot of improvement 1031 exchanges, but they are certainly out there. 1031 exchanges apply only to real estate. They used to apply to anything that was held for rental, investment, or business use. So we used to do exchanges of aircraft, shipping, trucking, vessels, equipment, livestock, etc. The 2017 Tax Act took all of that away so that we can only do 1031 exchanges on real estate now. Contrary to what you see on the internet out there, you can actually do 1031 exchanges for foreign property. A lot of what you see is statements that say you cannot exchange foreign property. And that certainly makes sense because it's not US property, it's foreign property, but it can be done. So the issue there really is that you are allowed to sell foreign property transactions and then reinvest in other foreign property transactions. So it does have to be foreign property exchanged for other foreign property. So when you see things out there on the internet where, you know, they say it cannot be done, what they really are trying to tell you is that you can't sell US property and exchange into or buy foreign property, and you can't sell foreign property and exchange into or buy US property. So when you're doing the 1031 exchange, it has to be all US property or it has to be all foreign property. You can't combine the two different ones. So that's what they really mean. They're not really trying to say you can't 1031 exchange foreign property. And having said that, let's move to the next slide. So a little more information on Exeter 1031 exchange services. We're actually one of the few qualified intermediaries that has any kind of government oversight. Our industry doesn't have any licensing capabilities. There's no regulatory body. There's no oversight of any kind. We've asked for it many times. I've been doing this for 40 years and we have approached federal and state agencies. I can't tell you how many times that asked to be regulated. They always come back with the same answer, that our loss ratio in the industry is not high enough, it doesn't justify it, etc. but all it takes is one loss, so it's a huge issue. We wanted to be regulated, so we chose to go down that path. We chose to go down the banking path, so we took a couple of years to go through the review and approval process with the Division of Banking to get our own trust company charter. So Exeter 1031 Exchange Services is the qualified intermediary that does all of the documentation, the paperwork, and administers the 1031 exchange, where the actual funds are held by Exeter Trust Company, which is the regulated entity. We're actually celebrating now our 20th year in business, so we've been doing this for a long time. Personally, this is my 40th year doing 1031 exchange transactions. So we've got a lot of experience and a lot of expertise from doing it for that long. And like I said before, we're more consultative and advisory. We really try to sit down with you, jump on a call with you, walk through questions, answer any questions you might have. If there's challenges or problems, we try to help you solve the problems rather than just saying, no, it doesn't work. So we always say, we've got the answers, go ahead, ask, give us a call. We are also available 24 hours a day. You can always get a live body to answer questions, and et cetera. And then kind of by segue there, I mentioned our regulated entity is Exeter Trust Company, and Exeter Trust is licensed, regulated, and audited by the Wyoming Division of Banking. That means that we are subject to licensing requirements. There's regulatory requirements. That includes different types of insurance. It includes equity capital requirements. We are subject to very strict regulatory requirements as well as an annual audit. So some of those requirements include fidelity bond coverage, which is crime insurance. So if any of our team members were to embezzle the funds, misappropriate the funds, you're covered. There's errors and omissions insurance coverage. So if we goof, if we create an error, if we omit something that causes you a loss, there's E&O insurance to cover that. We have a financial institution blanket bond, which covers a lot of different things. Thrown in there would be things like cyber fraud, wire fraud, and things like that are becoming more and more of an issue today. And that also gives us the ability to roll out other products. So Exeter Trust Company was really licensed, and we formed it specifically to hold 1031 exchange funds, so we would be regulated, which is a better protection for clients. But it also gives us the ability to roll out other products and diversify our product offerings. So we've rolled out self-directed IRAs and self-directed individual 401k plans, where investors can actually take their retirement account and invest in non-traditional assets, or some people call it alternative assets. And that would be things like buying real estate, deeds of trust, mortgages, tax lien certificates, private entities inside of your retirement account, and actually making that investment through or inside the actual retirement account. Those are things that we do that a lot of the brokerage accounts or brokerage companies can't do. We've also rolled out title holding trust or land trust. So for investors who want to negotiate, acquire, and hold real estate confidentially, we can set up a land trust or title holding trust to do that. And when there's scenarios where title companies or escrow companies cannot do some type of a specialty holding escrow, and often it might be a cash holding escrow after the close of some real estate transaction, if their regulatory body doesn't permit them to do that, we can take a look at it. So we do a lot of specialty holding escrows specifically for that. And we also offer just general self-directed custody accounts. So that kind of gives you a quick overview on who we are. With that, let's jump into the actual 1031 exchange process. Of course, the 1031 exchange is named after Section 1031 of the tax code. It actually is now celebrating its 102nd birthday or anniversary. So 1031 exchanges have been around for a very long time. And it's a tax deferral strategy that allows an investor to sell property that is held for some type of rental, investment, or business use, and defer the payment of the taxes. So all the tax consequences, such as capital gain taxes, depreciation recapture taxes, the Medicare surcharge, the 3.8% tax, and things like that can be deferred or avoided because the actual taxable gain is being deferred through the 1031 exchange by reinvesting in other rental, investment, or business use property. So with that, let's kind of jump in. The benefits, of course, it's tax deferral, like we just mentioned. A lot of the investors will call us and ask, what's the best way to take advantage of the 1031 exchange? When should I use it? When should I not use a 1031 exchange? Those are all good questions. And the first thing to keep in mind there is you always want to talk to your tax advisor. There may be things on your individual tax return that may not make sense for a 1031 exchange. There may be losses that could offset the gains, so it doesn't make sense to do the 1031 exchange. So you need to know exactly what the tax consequences from the sale of that real estate asset will be. You also need to know if there's anything else on your tax return that may affect the decision as to whether you actually do a 1031 exchange. For example, you may have net operating loss carry forwards from some other asset or business. You may have suspended passive activity losses. You may have losses from the sale of stocks or bonds, and a lot of those losses will offset gains triggered by the sale of real estate. So always important to check with your tax advisor, because the sale of real estate generally will trigger a taxable gain. The question is, can you offset the gain? Can you defer the gain through some strategy? Now, in most cases, that strategy will be 1031 exchanges. It allows you to defer the tax into the future by reinvesting in other property. The real benefit there is it keeps all of the money, all of your equity that comes out of your sale transaction, it keeps it in your pocket, so you have all of your cash available to reinvest in your new property. That means you have all of your cash so that it's a lot easier to trade up in value, to buy larger properties, to buy more units, maybe a larger multifamily property. It allows you to buy multiple properties so you can diversify your risk across multiple properties. And if you had to pay the taxes, it's a lot more difficult to actually do that. So in this case, it keeps all the money in your pocket, makes it a lot easier to expand your portfolio. And obviously the bottom line is trying to increase your cash flow and increase your net worth. The next question we get is, well, how long should I keep doing this, or when do I stop? It depends. That's my favorite answer. So in most cases, investors want to keep 1031 exchanging over and over and over. You keep deferring the tax, and when you pass on, you get a step up in cost basis. So that's a complicated topic, so let's try to drill down a little bit. Let's assume that you bought property years ago. You bought it for maybe $100,000. Fast forward to today, and it's worth $1 million, and you pass. When you pass, you're going to leave it to maybe your kids, your grandkids, a friend, whoever. They're going to inherit that property from you, and they inherit it at the current fair market value. So if it's worth $1 million today, their cost basis, because they inherited the property, is stepped up from $100,000 to $1 million. So now their cost basis is $1 million. They start with a brand new cost basis. The depreciation starts all over again. If they choose to sell the property the next day for $1 million, they literally sell it for $1 million. Their cost basis is $1 million. They pay zero capital gain taxes. So that's really the best way to take advantage of the 1031 exchange transaction, by continually to defer. You pass, you get a step up in cost basis, or your heirs get a step up in cost basis, and all the taxes go away. To remember that, we have a morbid sense of humor. We call it swap until you drop. So that'll help you kind of remember that. And it's all about continuing to exchange and get that step up in cost basis. Just one more comment there. A lot of people look at this as a transaction tool, and they just say, I'm selling property, I don't want to pay tax, so I'm going to do a 1031 exchange. But it's a lot more than the actual transaction tool. It's a wealth building strategy. It allows you to keep exchanging over and over and over, keep exchanging up in value, buying larger properties, and you keep building your portfolio, building your cash flow, increasing your cash flow, building your net worth, etc. And then at that point, you can make decisions on what you want to do. If you hold it all until you pass, then you leave it to whoever you choose to leave it to, and they get that step up in cost basis. So it's really more of a wealth building strategy than anything else. Now let's get into the actual structures. We talked a little bit about these at the very beginning during the intro. These are really the three most common, or probably, I guess, would say these are the three structures for 1031 exchange transactions. There's all sorts of subcategories here, if you will, different ways of doing these, but these are really your three primary strategies. 96% of our transaction volume would be 1031 exchange or forward 1031 exchanges, where you sell first and then you purchase or reinvest in your replacement property second. These can be done concurrently or simultaneously, where you close on the sale and you close on the purchase all in the same day. That takes a lot of the risk out of the transaction because you know you've sold and you've bought and you're done. You don't have to worry about identifying property because you actually closed on your acquisition. But concurrent closings are difficult to pull off. There's a lot of moving parts today. The risk is what happens if the seller on your buy side postpones the sale or something like that and the timing doesn't work out. So you have to be careful with concurrent exchanges and make sure all the moving parts are going into line. I'd probably recommend you leave a week or two in between so that if something goes wrong, you've got time to fix the issues. The other category, if you are subcategory, is a delayed exchange, and that is by far the most common, where you actually sell and close on the sale of your current property, and then you identify what you're going to acquire during the 45-day window. We'll talk more about that. And then you have 180 calendar days total to actually close on the purchase. So you're selling first, buying or purchasing second. The risk with this structure is that you're selling first, you close on the sale, and that means you've actually triggered your taxable gain. Now the question is, can you find replacement property, identify it, and then acquire that within those deadlines in order to defer the tax? If you can't, it becomes a taxable event, and unfortunately that just means you file it as a sale, a regular sale, and you pay taxes on it. But that's still the most common type of, like I said, 96% of our transaction volume, because it's much more straightforward, it's much easier, it's much less expensive than the other versions. Today's market is challenging. It's a tight market, tight inventory, higher interest rates. Sellers aren't really jumping up and down to sell because they have low interest rates from a couple of years ago. So the inventory out there is one of the problems. The higher interest rates are one of the problems. So you could go out, look for the new property first, take all the time you want. There's no deadline up front with a reverse 1031 exchange. Find the property you like, go under contract, negotiate, open escrow, etc. And in this case, you could actually close on the acquisition because you're doing a reverse 1031 exchange. Like I said before, this means that you can't take title to the property. You have to do this parking arrangement. So we actually set up an LLC just for your transaction. That LLC is used to acquire and hold legal title to the property, what the IRS calls parking title. And with that, once we acquire title, you then have the rest of the 180-day window to complete and close on the sale of your current property. So it takes a lot of the risk out of the 1031 exchange because you actually close on your acquisition. You know you've got the property, but they're a lot more complicated because of this parking arrangement. Lenders don't like them, and there's other operational issues that can be a challenge. But it does allow you to buy first and sell second, which solves a lot of the problems in today's market. The final one is the improvement exchange, which I went into enough detail, I think. It just means you're selling property, you're using the exchange to go out and buy property. That property you're acquiring is then acquired and held by us. So again, you use the parking arrangement just like a reverse exchange, and then you're using those funds, excess proceeds left in your 1031 exchange account, to actually make capital improvements to the property you've acquired. And any capital improvements that are both paid for and completed during that 180-day window will count as part of your 1031 exchange. If you pay for but do not complete an improvement, it would not qualify as part of that 1031 exchange. It's very important to make sure that you've got that lined up. It's all about timing and making sure you can get the stuff done and permitted and completed within that 6-month period. Okay, with having said that, let's jump into the next couple slides. The next couple slides are really the areas where there is the most confusion. And I'll point out what those items are, why it's confusing, why there's misinformation out there. I don't know if I call it misinformation, but you get a lot of opinions and people make it sound like fact. So we're going to point that out and explain why there's all those various opinions and what really matters, and then you can make a better informed investment decision for yourself personally. So having said that, you do need to set up your 1031 exchange in advance prior to closing on any of your properties. So again, most people do forward 1031 exchanges. So you want to have your exchange set up before you close on the sale of your current property. The reason for that is the purchase and sale agreement is assigned over to the qualified intermediary. So the qualified intermediary actually steps into your shoes and becomes the seller of the property. That's what allows you to defer the taxes. If the 1031 exchange is not set up prior to closing, then unfortunately it becomes a taxable event. There's no way to go back and fix that. You know, even if you tell the closing agent, don't disperse the funds, I'm going to do a 1031 exchange transaction, the fact that you closed on the purchase, or sorry, closed on the sale transaction means you have the right to receive the proceeds. So even if you tell the closing agent, don't disperse the funds, you still have the right to receive the funds, and it's taxable. There's no way to go back and fix that, unfortunately. So always have the 1031 exchange set up before closing. It means have your qualified intermediary selected, have them get in touch with your closing agent, etc. Very important, and I'm stressing this because we get calls literally every week where they say, I closed last week or last month or what have you, or I just found out about a 1031 exchange, but unfortunately it's too late at that point. And the qualified intermediary really does three things. They're going to draft all the documents to structure the 1031 exchange transaction. In a regular forward 1031 exchange, they're going to receive and hold and safeguard the 1031 exchange funds, the net proceeds from the sale. Or in a reverse 1031 exchange, they're going to acquire and park legal title to the property you're buying. And then the third role is not always as common, but really is important, which is we're more consultative. So the qualified intermediary should be able to help problem solve, should be able to help answer questions and walk you through the whole process, whether it be you, your advisors, et cetera. And that's critical in getting through these, because these are complicated transactions. The next area, which we've talked a little bit about, and that is it's very important to be regulated. And so I want to kind of reemphasize that. When you're choosing a qualified intermediary, you want to choose a qualified intermediary that has everything set up to safeguard your funds. Nobody talks about this, but it's critical because a qualified intermediary holds a lot of money for a lot of different clients, and you want to make sure those funds are safe. So I've been doing this for 40 years, and what I've seen is those entities that have failed would have been prevented had there been some kind of government oversight. Usually they're doing something that they shouldn't be doing, and if everything works right, it won't hurt the client, but things never work right. You get into a recession, and that's when you find out things don't go right. And that's when you find out the qualified intermediary's been doing something with the funds they shouldn't be doing. So government oversight is critical to make sure there's an annual audit, so somebody's looking over the shoulders of the QI and making sure they're operating in a safe and sound manner, and it's critical. So number one, the most important thing in my book is you want to have government oversight. That's why we spent all that time and resources to go down that regulatory path. Number two, you want to make sure they're bonded. So you want to check the insurance coverage that I mentioned before, the fidelity bond coverage, E&O insurance coverage, the financial institution blanket bond, which they'll only have if they're a regulated entity, things like that. And you want to check their equity capital. Number three, you want to make sure they're holding the money in a qualified trust account or a qualified escrow account. We don't have a whole lot of time on today's webinar to go into detail there, but if you want more information, you can search Land America 1031 Exchange, and that was one of the big four, big five exchange companies before 2008. They invested funds in areas they should not have invested funds. Long story short, they failed. The judge ruled that the client funds were actually corporate funds because they were held in the corporate name. And he also ruled that his ruling would have been different had the funds been held in a qualified trust account or a qualified escrow account. So it's critical that the exchange funds be held in a qualified trust or qualified escrow account. Okay, having said that, this is probably the most important slide in the slide deck. This is where there's also the most confusion, and this will probably ring true to many of you. A lot of people get hung up on how long do you have to hold title to property, in a 1031 exchange. We get calls all the time where they say, I was told that I don't qualify for the 1031 exchange because I didn't hold the property for at least 1 year, 1 year and a day, 18 months, 24 months, etc. And the question is, well, what does matter? I mean, how long do I have to hold title to the property? And it's amazing how many people say you have to hold it for 2 years. So to kind of clear that up and unravel the mystery, the tax code, the regulations, and rulings do not have any specific holding period required. There is no holding period. What it does say is you have to have the intent to hold the property for rental, investment, or business use. So one of the ways you can prove intent is to hold the property long enough to show that was your intent. That's why people get hung up on the intent. I guess the way I would answer that is if it's a plain vanilla transaction, you're not taking any risks, you're not pushing the envelope, you're selling rental property, you're buying rental property, nice and clean, a 1 year holding period is probably sufficient. Excuse me. 1 year holding period will straddle 2 tax years, 2 tax periods, and it's very good proof that was your intent, was to hold it as rental property or investment property. If you're pushing the envelope, for example, maybe you want to buy the property and at some point, maybe you'll consider changing the intent and move into it. You know, the 1031 exchange only applies to rental, investment, or business use property. So if you want to move into it at some point, you probably should rent it longer. Maybe you rent it for 2 years, which straddles 3 tax periods. Just enough to show that was your real intent. You did intend to convert it or hold it, sorry, as rental investment property, and then later you changed your mind and decided to convert it to some other use. So it's the length of time helps prove intent, but it's not the determining factor. So be careful there. Next level of area, or next level of confusion, I guess, is what is rental, what is investment, and what is business use? So we have to kind of define that because it's defined differently when you get into the 1031 exchange world. So of course, rental property means you've bought property, you're holding it out for rental income, you've leased it out, you're getting some kind of cash flow off of the property. But contrary to what you read on the internet out there, it doesn't have to produce cash flow. You could go out and you could buy vacant land and hold it for capital appreciation. During the 2008 recession, we had clients that sold large commercial properties, bought a whole bunch of single family or homes, townhomes, condos, etc., and just held them for capital appreciation and later sold them. They never actually rented the properties out. So as long as it's held for investment, that also qualifies. It doesn't have to produce cash flow. And third, you can actually buy a property and use it to run your business out of. Maybe it's a little office building or a retail shop or a warehouse or what have you. But if you're using it in your trade or your business, that also qualifies. The areas where it doesn't qualify is when you're buying the property to do something to it and then to sell it. You're really holding the property for sale as in inventory in your real estate business, as opposed to holding it for investment purposes. So examples of that would be, investors who buy property and their intent is to fix up and then sell. So they're rehabbing, they're flipping. That could be a condo conversion specialist. Maybe they buy it, put it under contract, and then flip the contract and sell it, which people generally call wholesaling. It could be developers, builders, contractors. All of those folks tend to buy property, do something to the property, and then sell it. And they're holding for sale. They're not holding for investment. Now, if any of those people were to buy property, do something to the property, and then hold it as rental or business use or what have you, it could qualify. So it all boils down to what's your intent, what can you prove if you get audited, and what's the usage. So a couple of examples to kind of bring this home. There's 2 tax court cases. Both were developers, completely unrelated. Both bought dirt, both intended to build single family homes. In both cases, neither one built anything. One held the dirt for 12 years, one held the dirt for 40 years. Both ended up selling, both did 1031 exchanges, and both got audited and both got disqualified because their intent, even though it was 12 and 20-year holding periods, their intent was to buy, build, and sell. So they're holding for sale, they're not holding for investment. That's why they were disqualified. Now, had they somewhere along the way said, my intent has changed. Maybe my business model has changed. Maybe the real estate market has changed. Maybe I'm getting ready to retire. It could be a lot of different things. COVID-19 reset a lot of people's agendas. It might be COVID-19. But something changed, and they could say, you know what, I am now going to hold this for investment purposes, not for development. And if they had changed the way they reported it on tax returns, financial statements, mortgage loan applications, and things like that, where it shows it's held for investment and not for development, their exchanges would have qualified. So changing intent will actually work. On the flip side, there's a case where this is actually an audit where clients sold, did a 1031 exchange, bought a condo, did not read the CC&Rs until after closing. At the time of, or a couple days after closing, quickly read the CC&Rs finally and realized it had to be owner occupied. It could not be held for rental. So he immediately sold it, did another 1031 exchange. As luck would have it, he was audited by the California Franchise Tax Board. In this case, he only held that one property for about a month and a half, and they actually allowed his exchange to qualify because he could prove that was his intent. It could be all the panicked emails going back and forth that would help document that. Keep in mind, emails are a great way to document intent, but they can be used for you or against you. So you have to be very careful with that. But that gives you some ideas on the qualified use. It's all about intent. The timing helps prove intent. So this holding period is just about helping you document your intent. It's not the real deciding factor. So whether it's 12 months, 18 months, 24 months, those are all opinions. That's why there's so much confusion out there. None of them are fact or law, but like I said before, if it's a plain vanilla transaction, 12 months is probably sufficient. If you're taking risks or pushing the envelope, maybe 24 months is more appropriate. The longer you hold it, the more tax periods you straddle, the safer it is. Excuse me. The other area we get a lot of questions on is like-kind property. And there's still a lot of misinformation out there. There's a lot of websites that actually will say things like-kind means if you sell a condo, you have to buy a condo. If you sell apartments, you have to buy apartments. That is not true. Like-kind is very simple. Like-kind means you are selling real estate, you have to buy real estate. It's as simple as that. So anything that would qualify as real property will qualify for 1031 exchange treatment as long as it's held for rental, investment, or business use. So things you would not even think about that would qualify, and we're going to show that in the next slide. The one thing to point out, which I mentioned earlier in the presentation, is like-kind does mean it has to be U.S. property for other U.S. property or foreign property for other foreign property. We've done foreign property exchanges now in about 45 different countries. So not all countries will allow a 1031 exchange, meaning that none of the countries out there have a 1031 exchange. Most of them don't know what it is. In fact, a lot of them think initially it's money laundering or something. So we have to get them past the fact that it is legitimate, it's part of the US tax code, but none of them really have anything like that on their books. So the question is, under local laws, regulations, closing customs, etc., can a 1031 exchange be structured? And there's certain countries like China is one example, Peru is another example, where the funds must be deposited into a bank account under the name of the seller, period. There's no flexibility there. So unfortunately, the seller has immediate constructive and actual receipt of the funds. So there's no way to set up a 1031 exchange in those two particular countries. And personal property no longer qualifies, which I mentioned before. Other than that, real estate qualifies. As long as it's real estate for real estate, then you're in great shape. So let's get to the next slide, talk about what does qualify. And all of these are like-kind to each other. So you'll notice that it would include things you wouldn't even think of. It includes air rights and water rights and mineral rights, oil and gas investments of certain types, fractional ownership. So if you do a tenants in common arrangement or if you do a Delaware statutory trust, all of those qualify as like-kind property for 1031 exchange purposes. So it's a great way to diversify from what you're currently holding into other areas that you think are going to do better for you. So obviously only you can define what that means to you, but this gives you some ideas on what you can exchange into. And just as important is what is non-like-kind property. What would be excluded from 1031 exchange treatment? And So let's talk about that. First area is anything with personal use. So your primary residence, a second home, vacation property, things like that. Anything with excessive personal use is not going to qualify for 1031 exchange treatment. Now, keep in mind, you can absolutely change intent. So in a perfect world, if it's a vacation home or a second home used for personal use, you would stop the personal use, convert it to rental property. If it was me, I'd probably rent it for 2 years to be very safe that it's clear I intended to change it to rental property because I have 2 years of rental activity which straddles 3 tax periods. That's just my opinion. But if you convert it, it could qualify for 1031 exchange treatment. So even though it's people say you can't do that, it's not completely true. There are ways to proactively plan, so you could qualify for 1031 exchange treatment. Now this area gets a little more complicated, so we don't have a whole lot of time to cover that, but I'll mention it real quick. Those of you who own real estate inside of an entity, so it could be a corporation, a partnership, a limited partnership, a LLC, a irrevocable trust, a revocable trust, etc. We have to drill down and determine who is the real taxpayer. So for example, if you're selling in your individual name, you're the taxpayer, obviously. When you go to buy replacement property, you need to buy it as an individual taxpayer. What you see out there in a lot of brochures and a lot of articles on the internet, and even people tell you verbally, you have to sell and buy the properties in the exact same legal name. And that is not necessarily true. It doesn't have to be the exact same legal name. It does have to be the exact same taxpayer. It's easier for people to say it's got to be in the same name. They don't have to explain what that means, but it's not completely accurate. So let me just use one example, and that way it kind of brings it home. That is, most people nowadays are using LLCs. So let's say you get 3 or 4 or 5 investors together. You set up one LLC. The LLC goes out and buys property. Maybe it's multifamily. You hold it for, I don't know, years, 5 years or so as investment property. You go to sell. You sell the property. You set up a 1031 exchange. You go to buy replacement property in the same LLC. And the lender says, nope, I will not lend in an LLC. That's a problem because the LLC has 3, 4, 5 members, so it's treated as a partnership for tax purposes. If you don't buy in the same LLC, it's going to be considered a different taxpayer. That's the problem. So if you buy in the same 5 individual names, that is not the same as the LLC, which is a partnership. Flip side, maybe you as an individual, you set up an LLC. It's a single member LLC. You are the sole member. It's a disregarded entity for tax purposes, which means it doesn't file a federal tax return. You own multifamily property. You sell the multifamily property. You do a 1031 exchange. You go to buy replacement property, and the lender says, no, I will not lend in an LLC. In this case, you could still purchase in your individual name. The lender will be happy and won't have a problem with it if that's their issue. Because this LLC is a disregarded entity, it's treated as if you're the owner anyways for tax purposes. So you can buy as an individual. Same thing for living trusts. Living trusts are fully revocable. They're grantor trusts. They're disregarded entities. So let's say a husband and wife have a living trust. They sell the rental property. They go to buy rental property through a 1031 exchange, and the lender says, we will not lend to a trust. They could take title as husband and wife as long as it's considered to be the same taxpayer. So it doesn't necessarily have to be the same legal title holder. They do have to be the same taxpayer, and that's really the issue. So for those of you who own real estate inside of a some type of an entity, now's the time to ask the question, what do you think your exit strategy is going to be? If it's going to be something like a 1031 exchange transaction, the next question is, are we holding title the best possible way in order to provide whatever flexibility we need to do a 1031 exchange? Now's the time to make changes, to restructure, whatever it needs to be. You can, happy to chat with you if you want. We can kind of walk through some options, bring in your legal and tax advisors to make sure we help you restructure what needs to be now so you're ready in the future for the exit strategy. Having said that, 1031 exchange deadlines. So first of all, the 1031 exchange deadlines all start running with the sale of your current property. So let's say your property sells and closes today. Tomorrow's day one. You've got exactly 45 calendar days to identify what you're going to sell. And at that point, you've got to identify it no later than midnight of the 45th calendar day. And there's no extensions allowed or anything like that unless there's a natural disaster and the president declares it a disaster area. Otherwise, it's set in stone. There's no way to get an extension. In fact, the IRS doesn't really have authority to grant an extension. So it's important to remember when the closing occurs, you've got 45 calendar days to identify the property. Now, here's some strategic ideas. Again, this is a tough market, tight inventory, et cetera. We've talked about that. So if you could delay the closing of the sale of your relinquished property, then your deadline doesn't start running yet. So you can always, when you market the property, tell the buyer, look, I need you to cooperate. I'm doing an exchange. I need you to give me a long-term closing, or I need you to provide us with a number of 30-day options to extend. If they say, look, I've got to have the property now, you can always lease it to them with an option to buy. So anything you could do to tie up the buyer, give them what they need to keep them happy, but not close on the sale means your time frames haven't started running yet. You could also start looking for property early. And if you find property you like and the seller's willing to cooperate, you can negotiate, go under contract, open escrow. As long as you don't close on the purchase, you can do a closing on the sale and then close on the purchase. You've tied up and you control when you close. You could do that. So it's all about timing and what you can do to get these moving parts to come together the way you need them to. You can also look at the Delaware Statutory Trust as a backup strategy. So some people just say, look, I want to go out and find my own property. I want to be the manager of the property. I want control of the property. But sometimes things don't work out right. So you could always identify a Delaware Statutory Trust as your third backup property, just in case things don't go as you had planned. Once your 45-day period passes, you have an additional 135 days to actually complete the 1031 exchange transaction. So that means actually close on the purchase of your new property. So be careful. It's not 45 plus 180 days. It's 45 days to identify, an additional 135 days to complete the exchange for a total of 180. The 45 days is part of the 180-day window. If you're getting closer to the end of the year, keep in mind any transaction that closes after October 17th might have a shorter than 180-day window because the 180th day will fall after April 15th, which is the due date for individual tax returns. Just keep in mind you can file for an extension of time to file your tax return, finish your 1031 exchange, and then file your tax return. Make sure you finish your exchange within the deadlines before you actually file your tax return. The identification requirements, we get a lot of questions on this as well. And a lot of folks will call up and say, well, I understand you can identify or change your identification after the 45-day window. That is not true. You do have to identify during the 45-day period. Anyone who identifies after the 45-day window, technically that is tax fraud. You cannot go past the 45 days unless it's a disaster declaration. When you're identifying in that 45-day window, you really have three rules to look at. Most people use the three property rules. So you identify property 1, 2, and 3. There is no limit on the value. You can only identify up to 3 properties. That's the limit, is on the number of properties. It doesn't matter what the value is. And you can acquire one of them, you can acquire all 3 of them. As long as you're trading equal or up in value, you're in good shape. Now that's because most people sell one asset and then reinvest in another asset of equal or greater value. They're usually trading up in value. So they want to identify 3 properties, each of which individually are probably greater in value. However, if you're selling one property and you want to go acquire a bunch of smaller properties, you can look at the 200% rule. The 200% rule is a limit on the market value that you identify. There is no limit on the number of properties. So for example, I'll use a specific example. We had a client about 2 years ago, sold a $4 million property in California and wanted to buy a whole bunch of single family properties. So he used the 200% rule. Sale price was $4 million. 200% means the limit is $8 million, so you double the $4 million. He went to Tennessee. He identified over 50 single-family residential properties in Tennessee, and he bought actually about 20 some. So over 20 of those 50 some properties identified, he bought 20 some. So the 200% rule allows you to identify a lot more properties with no limit on the number, just a limit on the market value. Doesn't mean you're going to buy all of those. It means you have more to look at, more to do due diligence on, more to choose from. And as long as you trade equal or up in value, you're okay. So in his case, the 20 some that he purchased means that he bought more, just a little over $4 million in value. So he reinvested his full amount, but he identified 50 some that gave him a lot more to choose from. Then you get folks that, let's say they're buying a portfolio. So I'll use one lady as an example. She identified 40 single family properties. We called her and said, look, this 40 is more than 3. The total value of these 40 properties was way over 200%. And she said, doesn't matter. It's one seller, one purchase and sale agreement, one closing. I'm either buying all of them or I'm buying none of them. So in that case, she closed on all 40 properties, which means she bought and closed on more than 95%. So she falls into that exception. So in her case, she's still okay, even though she violated the 3 property and the 200% rule, she's still closed under the 95% exception. So that kind of gives you a whirlwind tour on just the identification process. It gets complicated. There's all sorts of ways to customize the identification form depending on your specific situation. But the ID does need to be specific. It needs to be unambiguous. So for example, if you're going to identify a condo, you cannot identify just the complex. You have to identify the unit that you're going to buy. Otherwise, under audit, they would disqualify that transaction. And the identification should be made to the qualified intermediary. This is one of the 3 areas that gets the most misinformation out there, and that's the reinvestment requirement. A lot of investors think all they have to reinvest is just the net cash proceeds that come out of sale or just the taxable gain. None of that is true. It's really the top level that has to be reinvested. So just to keep the numbers easy, let's say that you're selling property for $1 million. How much do you have to reinvest? On a $1 million sale, you are allowed to subtract your routine selling expenses. So your broker's commission, title, escrow, documentary transfer tax, recording fees, and things like that. So on a $1 million sale price, when you subtract those, your net sale price after those routine selling expenses, it's going to be about $950. That's the magic number. That's what you have to reinvest in order to defer all of your taxes. So it's not the gain, it's not the net proceeds, it's the top level. You've got a net sale price of about $950. That's what you need to reinvest to defer all of your taxes. So you sold for $1 million, your net is about $950. You do not subtract your mortgage. It's only those routine selling expenses. You go to purchase the replacement property, whether you buy 1 or 2 or 3 or what have you, as long as the total purchase price is equal or greater than about $950, you've deferred all your taxes. So you want to be able to say you've traded equal or up in value, so then you've deferred. The best way to look at it is the government's really taken a position that you own this asset that's worth a net of about $950, and as long as you remain fully invested at that level, they let you defer all the taxes. We're going to talk about a partial exchange in a minute, so you can trade down in value, but we'll talk about that in just a minute. The other 2 areas you want to look at is, number 1, you want to trade equal or up based on the net sale price. You also have to reinvest all of your cash equity. So all the cash that comes out of your sale needs to be reinvested. And then most people talk about replacing the debt. You don't really necessarily have to replace your debt. What you do have to do is, let's say you've got a $1 million sale price, 600,000 debt, 400,000 of equity. You need to buy for a net of, say, $950, like we talked about. So you purchase one property for $950 or more. The 400,000 of equity has to be moved across the board to the new property. That's reinvested. The difference between your purchase price of the new property minus the $400,000 of equity will be either a new loan or new out-of-pocket cash, or a combination of the 2. So you don't have to replace the debt. And a lot of stuff out there says you have to replace the debt. Well, most people do because they don't have enough cash laying around. But if you've got the cash, you can certainly replace the debt with cash. You could buy $1 million property, pay all cash for it, that would still qualify. Partial 1031 exchanges. So a lot of what you read on the internet says you have to trade equal or up in value. You have to reinvest all of your cash equity. You have to replace your debt. Well, that's true because most people want to defer all their taxes and they don't have extra cash laying around. But you could also do a partial exchange. You can trade down in value, and that's perfectly okay. So maybe you sell for $1 million and you reinvest at $800,000. You've traded down by $200,000. That's taxable. But the rest of your exchange is okay. It doesn't hurt the 1031 exchange. It just means you're going to pay tax on what's not reinvested. So you'll pay tax on the $200,000. They do not prorate your cost basis. So that $200,000 is going to be 100% taxable. It's applied to your taxable gain first. Generally, they allocate it to depreciation recapture first. Once you've taxed and paid tax on all your depreciation recapture, then it's applied to your capital gain rates. But it's not going to be prorated with your cost basis. It's going to be 100% taxable. You can also pull cash out. So a lot of people in the real estate world are real estate rich and cash poor, as the adage goes. So some people will pull out 50 or 100,000 or 200,000 in cash because they need a cash position. Perfectly okay, does not hurt the 1031 exchange. Just like the other example, you're going to pay tax on the cash that you pull out, but the rest of the exchange will be tax deferred. And this is the last slide, and then we'll start to take questions. So we've got some questions posted already, and then feel free to ask any follow-up questions as well. So special tax planning, this is one of my favorite areas. So going back to one slide where we talked about a primary residence, a second home, et cetera, those don't qualify for 1031 exchange treatment. They actually can if you change your usage. So my first example is going to be an actual case where we had a client that husband and wife bought property in La Jolla, California, owned it, lived in it as their primary residence for 42 years. They were having health issues, wanted to go back east with their family. The problem is their taxable gain, their profit was $8 million. So if they sold, they would get $500,000 tax-free under the 121 exclusion. And that is if you lived there for 2 out of the last 5 years, you get $250,000 tax-free if you're single, $500,000 if you're a married couple. So they would get $500,000 tax-free, but they would get hit with taxes on $7.5 million. And of course, that's going to push them right up into the top tax bracket. But there's actually an IRS ruling out that allows them to convert it from a primary residence to rental property. The question is, how long do you hold it as a rental property? And we recommended 2 years. 2 years straddles 3 tax periods. They lived in it for 42 years. So let's be conservative. Let's be safe. Let's rent it for 2 years to make sure that if you get audited, you can show you really did intend to hold that as rental or investment property. So they did that. They moved out, moved back east with their family, rented the property for 2 years. That straddles 3 tax periods. Then at that point, they sold the property. They get 1 more year to still qualify for the $500,000 tax-free exclusion. Because remember, you have to be able to say you've lived in it for 2 out of the last 5 years. So the minute you move out, that triggers a 3-year window in which you can still qualify for that $500,000. So in their case, they moved out, rented it for 2 years, then sold it, closed escrow, and because they can still say they lived in it for 2 out of the last 5 years, they did get the $500,000 tax-free gain. They can take that cash and do whatever they want to do with it. Then because they've also now rented it for 2 years, they can say, I've held it for rental, investment, or business use. They qualify for a 1031 exchange. So they got the $500,000 tax-free, and they also did a 1031 exchange and deferred the other $7.5 million into rental property. So great way to plan. It takes a 2 to 3 year window to go through that whole planning process, but when you've got a huge gain like that, it's worth that time frame and going through all that. The other areas, you got folks that maybe have multiple properties involved. They're either selling or buying multiple properties. The timing isn't going to work out. So it's possible to combine a forward and a reverse 1031 exchange together. So for example, let's say they're selling a property for $5 million. They find their replacement property that maybe is worth $10 million. So they're trading up in value. So they're going from $5 million to $10 million. Great, we're in good shape there. But the taxpayer says, you know what, that's a lot of money to commit. I'd rather sell a second property to pay for the excess $5 million that I'm buying. I don't have time to do that though. So we could do a forward 1031 exchange first. We sell the $5 million asset, we do a 1031 exchange. When the replacement property goes to close, we can close, but we keep it pending as a reverse. We're starting now a reverse 1031 exchange where they now have more time, another 180-day window, if you will, to actually close or identify and then close on a second relinquished property. So you can go from a forward into a reverse. So now you can sell two properties to pay for that one $10 million acquisition. And there's all sorts of possible scenarios there. So combining exchanges can solve various problems, especially when there's issues in terms of timing and what have you. And there's all sorts of ways of structuring more advanced structures. So if you have challenges, that's one of the things we love to do is sit down and talk to you about what are you trying to do, what can we get the use to get the job done. And with that, that's a quick, not kind of quick, whirlwind tour on 1031 exchanges. From here, we'll kind of take questions as we go. So any questions you might have, we'd be happy to answer for you. One of the questions we have is, let's see, how often do you see boot money applied to mineral deeds? Good question. So to kind of back up for those who may not understand the question, boot means you have sold property, you're doing a 1031 exchange, and there's funds not reinvested. There's funds left over. So people call it taxable boot. It might be that the entire exchange fails and it's all taxable boot. It might be that you've bought property and you have some cash left over and it's taxable boot. Historically, if you, let's say you sell a property for $1 million, you can only reinvest $850,000 because that's the property you found you like. You're now short $150,000. That's taxable boot. You could certainly take those proceeds and go buy something else, a second property, to use up the difference. And his question relates to mineral deeds. And so certainly air rights, water rights, mineral rights, or mineral deeds would qualify for that smaller amount of purchase. You could also use it for a Delaware statutory trust, although with a Delaware statutory trust, you do have to be an accredited investor. So make sure you discuss with your financial advisor the accredited investor status. But specifically to the question, how often do we see mineral deeds? That's a pretty small percentage of the transaction business out there. So I would say under 1% of the transaction volume would go into air rights, water rights, mineral rights, things like that. But it is done. Certainly a great way to do it. We've also seen exchanges of, billboards, cell site towers, vineyards, timberland, things like that. So lots of different types of assets can certainly be exchanged. As long as it's considered to be real estate, it would qualify for like kind and qualified use treatment. And then one of the questions we get a lot of is, what about fees and costs? So I can kind of give you an idea from that perspective, on both for what we charge, but also on an industry kind of, so you get an idea. So forward 1031 exchanges, of course, industry-wide are the most common types of exchanges. They've changed, the pricing has changed a lot in the last couple of years because of all the inflation we've seen. There's been huge increases in costs, et cetera. So the average forward 1031 exchange fee is probably $1,200 to maybe $1,500. Some go as high as $1,800. If it's a lot more than that, hopefully you're getting something else on top of it. For example, sometimes you'll have an attorney who does the purchase and sale agreement, et cetera, just for that transaction, and they're giving legal advice just for that transaction. They might charge more, maybe it's $2,500. If it's your attorney that does all sorts of other things, if it's a tax advisor or a real estate broker and they're doing other things for you, they're technically your agent. They can't do this for you. So that kind of gives you a range. So in most cases, it's going to be a qualified intermediary, an institutional qualified intermediary like us. And the fees are going to be between $1,200 to $1,500. Most common, some go as high as $1,800. For a forward exchange, one sale, one purchase, we are $1,295 or $1,295. That includes the first sale, the first purchase. Each additional closing would be $300 to process. When you get into reverse exchanges or you get into improvement 1031 exchanges, those fees are going to be all over the place. I would say the range for reverse exchanges is typically $6,000 to $10,000, depending on what's involved. The range for improvement 1031 exchanges is probably take the range and move it up by a couple thousand, so it's probably like 8,000 to 12,000. There are certainly providers out there that are cheaper. Be very careful with those. They either take shortcuts or they don't understand the risks involved. These get really complicated. You need somebody who understands all the moving parts and how to get things done. What are the next questions? Let's see, is on improvement exchanges, you are at risk by the contractors to complete jobs within the 180-day timeline. If they fail to do so, you pay hefty taxes, correct? Good question. So you're absolutely right. The risk with an improvement 1031 exchange is you've got that 180-day window. So getting permits and then starting the construction and completing it with that 180-day window is very difficult. So there's really two challenges with an improvement exchange. One is you have to identify what you're going to buy and what you're going to make improvements with or on in the 45-day window. Now, if you identify the entire project and at the 180-day mark, you're only, let's say, 60% done, have you really acquired substantially the same asset as what you identified? And if it's only 60% done, you've got a risk that under audit, they'd probably disallow it and say you didn't acquire the same property, substantially the same as what you identified. So the challenge is, how do you identify property when you're not quite sure what you might get finished? Second issue is if you're pretty good at guessing what you might get done in 6 months, but then something goes wrong, the contractor walks off the job, weather, whatever it might be, and you don't finish, then absolutely you pay taxes on whatever's not completed. Unfortunately, that's just kind of the way it goes. And let's see, one more question on foreign property. Let me see if I can paraphrase this. This is one through email. So effectively they're asking, on a foreign property 1031 exchange, do you have to sell and buy in the same country? No, as long as it's a foreign property, foreign country, it will qualify. So, you know, you might sell in the UK and you might reinvest or buy in Belize, something like that. So as long as it's foreign property for foreign property, does not have to be the same country. Each country has their own laws and regulations and customs, so we have to talk to the closing agents, find out exactly what's involved with those particular countries, and it's always interesting to find out what has to be done. So we kind of go from there. And it looks like that's the end of the questions. Any other questions you guys would like to throw out there? I'll give it a few minutes just in case you think of one. You're welcome. Thank you. Thank you for the appreciation. I appreciate it. I appreciate the appreciation. I think that made sense. Okay, it looks like that's all the questions at this point then. So I guarantee we'll always come up with new or additional questions in the future. So feel free to reach out to us. We're always happy to brainstorm, troubleshoot. You know, we try to be problem solvers. So whatever it is that we can do to help, let us know. Be happy to jump on a call and just kind of walk through the issues and try to accomplish what you're trying to do. So thank you everyone for joining us today. We very much appreciate that. We look forward to talking to you and look forward to working with you in the future. Thank you, and please reach out when we can be of assistance. Take care. Bye-bye.